We've seen a huge surge in ESG ETFs over the past few years, but it's fair to say this year, you could say the ESG market's in a bit of a state of flux at the moment. We've seen slightly waning demand and there's a lot of regulatory uncertainty out there. So to discuss this, I'm delighted to be joined by Paris Jordan, Head of Responsible Investment at Charles Stanley, to look at the upcoming SDR and also how she's using ESG ETFs within portfolio. So Paris, thank you so much for joining me here today. So diving straight into it, as I mentioned, we've seen a slight drop off in kind of ESG ETF flows, 50% decrease quarter on quarter. Just from a very sort of broad perspective, how are you seeing the ESG market at the moment? What's your take?
Cool. Well, thank you very much for having me. First of all, the ESG marketplace is definitely a question that I have had from a variety of peers, even regulators, and definitely clients. What is particularly interesting, and I think we've been saying it for years, is the evolution of ESG completely and utterly accelerated back in 2020. So it's not that surprising to those of us who are in this space that it has had a bit of a cool off. There's a very interesting chart called the Gartner hype cycle, and it's all about how you get this overexuberance, you get this disillusionment, and then eventually you get to the point of effective maturity. And so I was having this conversation yesterday about where were we on that particular cycle, and really there's no doubt that there's certainly been a lot of disillusionment that has occurred in the marketplace. I think to some extent that's probably why the regulator has stepped in with some of the proposals that they have brought out or to be bringing out or will be bringing out. And so certainly we're still in the phase where we've not quite recovered to that maturity point. We won't see the same hype that we saw back in 2020, but it has forced us, particularly practitioners, to sit back and come up with really reasonable arguments about why ESG is still relevant, and not just still relevant, but why is it going to continue to be relevant in the next 5, 10, 20 years. So when we say that flows have decreased, and certainly in some ETFs, we've seen actually flows go out. But if we take a look at the assets compared to 2018, and then 2020, which went up, we're still ahead now than where we were in 2018. So while things are slowing down, there are people that have raised some very valid questions. This maturity, or this point where we now need to kind of turn it into a very adult conversation is well needed and valid. So in some ways, I would say that it's still actually quite exciting, because now we're not just full of this, hype bubble. We're actually proving its worth and why it's still here. Going forward, I hope that those flows start to recover. Absolutely. But do I want them to be over exuberant again? Absolutely not.
Yeah, it's really interesting. You mentioned there around sort of the more coherent arguments and that sort of 5 to 10 year time horizon. And this might seem like an obvious question, but why is kind of ESG here to stay, do you think, over the next kind of decade?
Absolutely. That is the question that all of us writing our strategies try and work out as to why. And I think it is really as simple as this. ESG is a fundamental research process. We are looking at factors, environmental, social, governance, which traditionally have been non-financial. But as we move into this, new regime ultimately, and a massive regime shift is happening underway because of climate change, these non-traditional, non-financial factors are starting to become more financially material. They are impacting supply chains. They are impacting business operations, and consequently, they're affecting bottom line. So you can ignore ESG factors, but if you want to ignore the impact drought is having on your supply chains, then you're going to be in a bit of a sticky situation come explaining to your investors why you've not shipped a product from A to B. Because I didn't look at drought. It's not something that you can ignore anymore. So ultimately, ESG is here to stay because it's becoming much more financially material.
Yeah, great stuff. And then obviously, as I mentioned at the top there, SDR is a kind of huge focus in the UK. I won't even mention SFDR, which is obviously what's happening in Europe and the EU. But just from a very broad perspective, what impact will SDR have on the kind of UK market?
So UK market, if we think about it broadly, it will definitely have an impact. It will allow clients very easy, almost view of what that particular fund is doing. And it boils it down into 4 more simple labels. Although we have seen from some client testing already, there's still confusion around it. But with anything new, there's going to be confusion. When we think specifically on ETFs, this is where it gets a bit more interesting, because there's a huge amount of debate around the labels and how they are more appropriate for, let's say, active capital. You're looking for improvement of some form, you're looking at impact of some form, or you're looking at a very specific focus. So from my perspective, I'm very excited to see over the next 6 months at least what some of the ETF houses come out with. I think that we might see some focus labels for some thematic ETFs. I think they'll be able to qualify for those as long as they've got their objectives and KPIs correct. Where it comes to things like improvement and impact, I think it's going to be tougher for ETF providers to actually meet those particular hurdles. But what it might do is it might allow some of them to actually demonstrate some of the engagement that they've been doing kind of behind the scenes that they haven't really actively pushed because, of course, they're passive flows. So we'll either see this big kind of difference between active managers meeting sustainability hurdles and passive not using that capital actively, or we'll find that there starts to be some really interesting changes in ETFs and passive houses about how they think about sustainability going forward.
That's really interesting. Just on that point, is there anywhere within the ESG ETF market you'd like to see kind of further product development to help you build better portfolios?
Yeah. So I think we're pretty saturated in the Paris-aligned index funds. We've got a fair amount out there from a variety of providers. I also think that from a thematic perspective, we've got some brilliant products, whether they be climate-focused, environmental, water, and some very niche other ones as well related to foods and even pharmaceuticals in some respects. Where I have yet to solve for, and I'm not sure if ETF providers are able to do so yet, is really that impact piece. We know that impact has traditionally been active capital. It's what you put in and kind of what you get out, and really kind of working and sweating that the money that you invest. How providers for ETFs create something from an impactful lens while still keeping it fairly passive and costs down. I'm not sure if I can square that circle yet. So maybe I'm asking for something that's not even possible. But in terms of kind of product availability, that certainly would be ingenious, whoever creates something along those lines.
Yeah, that's really interesting. And just sort of bringing it out more broadly, how do Charles Stanley and yourself look at incorporating ESG ETFs within your portfolios? What role do they play?
So we run responsible investment models here at the firm, and over 50% of those models does invest passively, invest in ETF and other index providers as well. And what we are seeking is a variety of things. We're seeking those that can meet certain criteria for us. Clearly, the negative screening criteria has been very popular with a lot of our clients. And so when you're building and constructing your ETF, those things are, from a quantitative perspective, very obviously applied and easy to do so. But we also use them because, we see a lot of added value from some of the houses that we use. Like I say, there are those that are doing things more in the background related to voting, stewardship and engagement that we really do enjoy. And of course, when we're building those responsible investment models, we can use some of our active funds, but actually those the ETFs tend to be more of our core holding. They reduce the price, they still meet a variety of hurdles, and they end up with a very diversified exposure. And what we've seen with them is that because we've been using ETFs, that we haven't had quite so large style swings as some of the others in the marketplace who have followed quite a sustainability approach, resulting in more growth exposure and consequently challenging times when the market rotates. So what we found is by using ETFs that meet certain sustainability criteria, I joked earlier about the Paris alignment, but also those that meet those, have managed to help balance our portfolios and give really good client outcomes.
Yeah, that's really interesting. And then just finally, what are your sort of biggest bugbears when investing in ETFs? What are the biggest challenges you find when looking at this market?
The biggest bugbear, that's a really tough one, because there are so many pros to the ETF market versus, the fund market. But I think it probably comes back to that active capital, because we're moving into a world around where, or at least in the UK, where sustainability is being forced, or not forced, but it's being encouraged, it's evolving towards being active stewards. So historically, where we've been lower down the spectrum of capital, for those that have heard of it, we focused on negative screening. We focused on construction based on X, Y, and Z, and this is the output. But going forwards with the new regime, sustainability is much more focused on that kind of active piece. So how passive managers adapt to that is going to be fascinating. So while not a bugbear, more just a curiosity about the adaptation of ETFs to a changing regime.
I think that's a great point to end on. Paris, thank you so much for joining us today.
Thank you very much.